Okay, good evening, everyone. Hopefully you all can hear me. If anyone's having any difficulty, please do just feel free to let me know in the chat or the Q&A box. We've got both going this evening. So as we go through, if you have any questions, anything you want to raise, anything you want us to go into a little bit more detail on, please do stop me and we can certainly spend a bit of time on that. But if anyone's having any audio or technical issues, please do also let me know. But otherwise, let's get started. Thank you very much for joining us this evening, firstly. Obviously, it's a public holiday in Singapore and a number of other countries in the region for the end of Ramadan. So appreciate you giving up your public holiday for those of you that are. We've got quite a lot to go through this evening. So we're going to cover a few aspects: what was announced in the budget, how that might impact those of you that are Australian residents and those of you that are Australian expats, i.e. not living in Australia, and of course those that are thinking about making a move either way. So there'll be plenty to cover. We'll cover all the highlights of the budget, particularly those highlights that are relevant. But as I said, please do feel free to stop me and ask any questions as we go through. More than happy to answer anything. Now, before we get into it, just our standard disclaimer, nothing you hear here this evening is personal advice. It is all general information only, and hopefully there'll be a bit of entertainment that comes along with it. So don't take anything we hear, that you hear here this evening as advice. Be sure to reach out to your accountant or to your financial planner and make sure that it actually aligns with your own circumstances. But otherwise, let's get into it. So a little bit about what we're going to cover this evening. I'll give you a very brief background for those of you that don't know me or our company, exactly who we are, where we fit into the market and what we do. I don't want to spend too much time on that because I'm certainly aware of the fact that you're here to get as much value out of this evening as you possibly can. What was announced in the budget? How does it impact you? So that's what we're going to spend the majority of the evening on. So we'll go through the good, the bad, and the ugly of the budget, some of the key announcements, how it impacts Australian residents, so both individual and corporate. So if you have a company in Australia, we'll look at some of the key changes for Australian expats, some of which were actually positive, a few things that were missing, a few things we would have wanted to see in the budget, and then where we are looking to invest, I guess, in part on the back of the budget, as well as how we see markets, I guess, over the next sort of 12 to 24 months. And as I said, we will have time at the end for Q&A, but if you do have any questions, as I mentioned, for anyone who's just joined us, if you do have questions as we're going through, chat and Q&A box right there, just pop them in and we'll get to them as soon as we can. So a little bit about us and very briefly about myself. My name is Jarrad Brown. I'm an Australian financial planner. I worked and grew up in Perth and have been in Singapore now for about 8 years. And we set up Australian Expatriate Group as a division of Global Financial Consultants with the very appropriate acronym GFC. Now, GFC, interestingly enough, was actually originally established in Sydney in 1997. And then moved to Singapore in the early 2000s. So we're now actually one of the oldest non-aligned, meaning we're not owned by a bank or insurance company, advisory practices in Asia, which is certainly something we're very proud of. We work with Australian expats all over the globe. At last count, we have clients in about 27 countries, and that will continue to grow over time as our clients move around. And obviously as more and more people hear about what we do, we like to think we do what we do very well, and that is Australian expat financial advice. So enough about us, let's get into the budget. So first and foremost, we'll touch on some of the highlights that were announced in the budget, and we'll also have a look at the Australian economic forecast as well. Because particularly as expats, while the highlights and the announcements are important, we also need to be mindful of, if you're anything like me, where is the Aussie dollar going? Where is Australian property going? What should I do with my superannuation? What should I do with my international investments? All of these questions as an expat, regardless of whether I plan on returning in 12 months' time or 12 years' time or anything in between. So let's get into some of the highlights. Now, this year's budget has been described as a bit of a buffet budget, which basically means that it was designed to address as many people as possible. Now, the cynic in me would assume that is because we are on the cusp of the next election, and we are nearly 8 years into the current leadership, and that may or may not change at the next election. So this budget was very much a spend, spend, spend budget in as many places as possible. That would get them as many votes as possible. The unfortunate part with the buffet type budget is it lacks a lot of direction. So there's a lot of money thrown in a lot of directions without any clarity of what might be next. That being said, let's get into some of the highlights. So first and foremost, as will probably come as no surprise to many of you, we are in a deficit. Nobody really seems to care anymore. It will be a future generations problem. And the forecast currently is a little bit less than expected. And that is that we will have a deficit over the next 12 months of $161 billion. Now, we were forecast to hit somewhere between 190 and 200. In part, we can thank a very strong iron ore price for that deficit being lower, and obviously a very aggressive government stimulus supporting a lot of the economy, but it's still a lot of money. So Labor or Liberal, it doesn't really matter anymore in terms of spending. It's a very large number. We are going to need to get out of that debt somehow. GDP growth is forecast to be quite strong, both in nominal and real terms. So we're looking at 3.5 to 4.5 or 4.25% over the next 12 months. And again, a lot of that has been driven by very strong commodities growth, quite a resilient Australian economy, on the back of the fact that we have actually handled COVID quite well. Now, you could argue that we might have bungled the vaccine rollout and that it's been more luck than careful management in terms of the low numbers in Australia. But whichever the reason, our case numbers have been very low and the state economies have been able to actually reopen relatively quickly. Now, net debt is going to be very high, and what's potentially more concerning, depending on your view, is the fact that the forecast is that we're going to peak just shy of $1 trillion Australian dollars in debt by 2025. So that's the $980 billion that is forecast there. So as I said, this is very much a spend, spend, spend budget, and it will continue for at least the next 3 to 4 years. The good news is unemployment is forecast to drop quite drastically compared to the original forecasts. So we're looking somewhere between 4.5% and 5.5%, which is great. There are still lots of people who don't have jobs. There are also lots of sectors and industries who can't find employees. So while our unemployment figure officially looks very good, it looks very low, anything below 5% is considered quite a tight economy, quite a healthy number. The fact is a lot of these jobs are part-time. A lot of people are claiming to search for work, therefore forming part of the labour force, even if they may not be terribly interested in anything long-term. So we are getting some skewed numbers at this point, while a lot of the government incentives remain in place. That being said, it is a healthy number. We are expecting unemployment to continue to drop, even though we're not expecting huge wage growth over the next 2 to 3 years. So they're really the sort of macro highlights of the budget, if you like. In terms of some of the specifics, now I mentioned it was a bit of a sort of a catch-all. We're going to spend a lot of money in a lot of different directions, and these are really the key areas. Now, I won't spend too much time on this because I really want to spend more time on the individual and the business announcements that have come about in the budget, but really just to give you some of the top level highlights that have been announced in this year's budget. In terms of tax relief, we've had some corporate and individual tax concessions. The individual are very much for the middle income earners, so your $40,000 to $90,000 annual income. We've also had some corporate tax concessions. Now, we'll get into those a little bit later. There's not been anything terribly new or terribly exciting, but there have been some positive announcements on that front. Now, obviously, this was going to be a year of throwing lots and lots of money at creating jobs. We are seeing aviation, tourism, hospitality, education tourism, healthcare tourism, anything reliant on people coming into the country getting decimated. And as will come as no surprise, we have thrown a bit of money at it. You could argue it's not enough. The $19 billion that's gone to our universities when they are heavily reliant on international students really isn't going to make the world of difference. But at least nice to see that it is on the radar, and hopefully the money that is being thrown at apprenticeships gets people into new jobs and gets them into the right sort of employment. In terms of defence, we are forecast to spend more money on defence going forward, particularly, I guess, given relationships in the Southern Hemisphere at the moment. There's not been anything terribly new or exciting announced here. We're going to upgrade some facilities. There's going to be a new facility launched near Cairns, and we'll have some money going into creating new jobs there. Infrastructure is a big one. One of the key ways for any government, in this case the Australian government, to create new jobs is to throw lots of money at infrastructure projects. So we've seen $110 billion announced over the next 10 years to go into different infrastructure projects. So we've got Metronet in WA, we've got the Bruce Highway in Queensland, we've got a number of different projects that will all start and be completed, hopefully, over the next 10 years that will create new jobs. The question is it going to be enough to place any sort of pressure on wages going up based on the number of jobs it will create? The initial forecast suggests no. What's also been a little bit disappointing here, which we'll get into, is the fact that we've not really seen any meaningful money injected into clean energy. And that really brings us to the next point around the environment. So we've had just shy of $500 million directed to funding into what they call environmental assistance. We've had $1.6 billion go into clean energy. However, it's not zero emissions energy, it's just cleaner than we already have in place. We've got some of that money going into hydrogen, some of that money going into carbon capture, but really not enough going into clean renewables to actually compete with other countries in the region. So this has been quite disappointing, the amount of money that's gone here, but given that we are somewhere between 0 and 12 months from the next election, it probably shouldn't come as any meaningful surprise. The healthcare announcements, look, we've had some money again thrown at disability spending and aged care. It was badged as the current leadership as a bit of an aged care budget, which is probably a little bit of a misnomer. We've had enough money thrown at the system to create 80,000 new places. There are currently 100,000 on the waiting list. So it's a step in the right direction, but not a large enough step, to be quite honest. So again, the government is waiting on the Royal Commission that is currently being conducted into the aged care space. That's not quite a Royal Commission. It's more an investigation in terms of both the pros and cons of what currently works and what doesn't. So we are genuinely hopeful that we'll see some more meaningful support for this sector once that investigation or that commission is actually complete. In terms of social support, again, we've seen some money thrown at childcare. If you have 2 children, you'll be eligible for greater support than if you only have 1. So the incentive there is Australia wants more children, a younger population. No real surprises there. Again, we've got a greater social security net. Again, this budget was badged as a women's budget in that we were going to throw more money at female leaders, at females in general, which again was a bit of a misnomer. We've thrown a little bit of money at childcare. However, paid parental leave still remains the only form of leave in Australia that doesn't attract superannuation payments. So it highlights a huge need for planning. It's a huge gap, and it really didn't do anything meaningful to actually support the gap in retirement savings when it comes to men compared to women, particularly in Australia. The other one was we saw an increase in the job seeker payment of $50 a fortnight. Now that's great, depending on which side of politics you sit, but it is only while the job seeker remains. So if you are on some sort of support payment, it does make it very difficult to plan ahead. The other one is our digital economy incentives. So We have directed an amount of money into AI, into digital support, into various tax incentives. Again, we've suggested 124 million into AI. The AI and the digital community has come out to say if it's not 250 million, it really isn't going to mean anything, which you'd probably have to argue is not far from the truth. But nice to see again that at least it's on the radar, and hopefully we start to see this pick up, particularly if the Liberal Party is actually re-elected. So that's sort of where we're at in terms of the key highlights. In terms of the economic outlook for the country, again, as I said, it's all looking relatively positive. As you'll see in that real GDP number, that 2022-23 should be 2.5%. We're not expecting the economy to grow by 25, as lovely as that would be. Apologies for the typo. So we're expecting quite a strong bounce this year, and then a more sort of consistent growth, I guess, over the next 2, 3, 4 years. Wage growth, as I said, is expected to be fairly lackluster. While the infrastructure projects that the government's creating will create new jobs, we're not really expecting any meaningful increase in terms of inflation. Once a lot of the government support payments start to drop away, then again, a lot of that support or that upward pressure on wages will likely subside. So we're not really expecting any supply side inflation. And unless we completely destroy our relationship with China, we're not really expecting any demand side inflation in terms of consumer goods increasing in a meaningful way either. So that's why we're sort of seeing inflation remain fairly low, wages remain fairly low. The Reserve Bank of Australia has said that they won't increase interest rates until inflation is consistently between 2 to 3%, which is outside of their normal sort of modus operandi, where they will typically increase if they expect inflation to sit within that band. So again, it supports the hypothesis that we may see rates increase from 23, 24, 25, based on the current forecasts. And obviously the unemployment rate kind of ties into everything I've just covered. So the next question is, well, how do we spend all this money when we don't have it? And the answer is we create debt, we sell government bonds, and we worry about it later. Now, how do we worry about it later? Well, we do that in 2 ways, one of which is we can genuinely repay the debt in the form of higher taxes or higher government revenues in some other way, or we can try and inflate our way out of that debt, i.e. create high inflation through jobs growth, putting upward pressure on wages, which gradually inflates away that debt to some extent. But this is how the current forecast looks. So obviously 1920 or 1718, 1920, we had a fairly even revenue expenditure. We were getting close to that back in the black government budget. Now, obviously, the Liberal Party has basically abandoned those plans in terms of getting our budget anywhere near to back in the black. And this is where we are. We have one of the largest gaps between spending and revenue that we've ever had. But the expectations are that that will close at some point over the next 10 to 15 years. So we're looking at a deficit for the next decade. Best case scenario is the reality that we're dealing with. Do we think that's accurate? To be honest, yes. It may even be a little bit on the rosy side, depending on commodity prices, depending on Australia's economic growth, and also depending on how long our support payments actually have to last domestically. So what does that mean? Well, it probably means that our future generations, our children and or grandchildren may face higher tax rates in Australia, just when you thought that they couldn't get any higher. Now, in terms of our inflows, outflows, what does our gross debt look like? As we've kind of highlighted again, the budget is quite a high portion of our GDP at the moment. You could argue that has been necessary. Australia's economic growth has fared a lot better than many other countries. And as such, our share prices, our property market have done very well. And unemployment has probably risen less than you might have expected, particularly looking at sort of March, April 2020 forecasts. So on the chart we're looking at here, the MYEFO is the mid-year economic and fiscal outlook. So looking at what we expect growth to look like, and what do we expect the budget to look like as a percentage of GDP. So as you can see, we're not expecting that the budget or the current expenditure is going to increase terribly from where we are now as a percentage of GDP, but we're also not expecting a huge drop off for the next 10 years, which, as I said, means quite a large deficit that we're going to have to deal with for probably the next decade. Now, where is all of our money going? Or where does our government spend our money if we're paying tax in Australia? There's not a lot expected to change. Obviously, Social Security is going to increase this year in the form of JobKeeper and JobSeeker and everything else that's being paid out. We're obviously also seeing a lot of money go to various housing incentives and various industry incentives to keep the economy growing, to keep jobs being created. Outside of that, we're not expecting any meaningful changes over the next 3 to 4 years. There will be some slight tweaks. Defence spending is expected to increase. We are looking to decrease the spending in terms of the economic response to COVID, i.e. a lot of the support payments will start to drop away. And obviously Social Security will start to normalise and get a little bit closer to those long-term averages. But it will probably take 4 or 5 years before we start to really see Social Security drop away in a meaningful way. So hopefully that gives you a bit of a snapshot in terms of what's going on domestically. The other important question that you potentially should be thinking about is, well, if the Australian government has all of this debt, how do they get the money back? Where might they think of getting the money back? And one important avenue to look at is, well, where do they currently get all their money? Because if they're currently getting it from somewhere, that's probably not a bad place to look to increase. And as will probably come as very little surprise, individual income tax makes up just shy of 50% of government revenue. Now, that's obviously quite a large chunk of the revenue stream. The other one you'll see on the top right there is the company and resource rent tax, which obviously makes up also quite a large chunk of that overall revenue. We've then got customs, fuels, excise, sales taxes, etc., but the majority are corporate and individual tax rates. So what that might lead you to expect is that we may see an increase in individual and corporate tax rates going forward. Again, depending on inflation, depending on economic growth, and depending on commodity prices also. So just an interesting way to look at what might happen. If you're in Singapore, if you're not in Australia at the moment, perhaps you don't need to worry too much just yet. The next important question is, well, where is the Aussie dollar going to go on the back of all of this? And obviously we saw quite a sharp pullback in the Aussie dollar around March, April of last year. And personally, I thought it would last a bit longer. I wasn't expecting the Australian dollar to bounce as quickly as it did, largely because I wasn't expecting the Australian government to act as aggressively and as promptly as they did with the support payments. So I thought I was an absolute genius transferring some money back from Singapore to Australia at around the 124 level. We hit about 125.5, and very quickly we were back at parity. And that was really driven by a very strong iron ore price, a very stable economic outlook for the country from the ratings agencies, and also reasonable inflation and quite a strong economic outlook domestically. And obviously there was also the fact that Australia has fared, as we've already highlighted, a lot better than many other nations when it comes to COVID. You know, we've remained fairly open with the exception of Victoria. You know, Western Australia was in lockdown for a matter of weeks, and then very quickly life returned to very close to normal, essentially. So domestic spending, economic growth domestically, people returning to work, all came back to life very, very quickly. And that's really highlighted in the expectations here. So widely, the iron ore prices, or the commodity prices, but largely the iron ore price, is not expected to drop in the short term. Hence the sort of stable outlook for the Australian dollar over the next 12 to 18 months. Beyond 2022-23, the expectation is that the Australian dollar will start to decrease, start to decline, depreciate against both the US dollar and the Singapore dollar. But really a key driver there is going to be the rest of the world starting to reopen from COVID, i.e. case numbers dropping, vaccine rollouts going successfully, and also Australian commodity prices starting to decline. So that's really what we're going to be waiting on. It's probably not something that's going to be happening in the short term, but in time we do expect that the Australian dollar will decline. So the next question is, based on all those forecasts, well, what could go wrong? What actually gets built into the budget? How does the Australian government or Treasury actually build these forecasts? And effectively, this is what we're looking at. So these are really 5 of the key variables that create the budget, i.e. the models that the budget is based on. So one, which is a little bit disappointing for us Australian expats, is that international borders are expected to remain closed until mid-2022. So we're looking at least another 12 months before there's any meaningful amount of travel. Net overseas migration, i.e. people coming into Australia, people leaving, is expected to remain negative for at least the next 18 to 24 months. I.e. the people leaving Australia will exceed the people coming into Australia for the foreseeable future. And that's obviously putting pressure on certain sectors in terms of jobs growth and also inflation. Now, interestingly, the iron ore price is still forecast to drop to $55 a tonne. It's currently around 237. So as you can very quickly work out, we're a long way from that forecast. And that would put tremendous downward pressure on the Australian dollar if we got anywhere near that forecast. The other one is the Aussie US dollar exchange rate. It's expected to remain at current levels, as I said, for the next 18 months, and then drop to around the 70 to 72 cent mark against the US dollar, and then also drop to around the sort of 70 or high 60s going sort of 4 or 5 years out. Now, bear in mind that is a long way out to forecast the exchange rate. But as I said, what's really going to drive a downturn would be a decline in the commodity prices in iron ore prices. And the other one is population growth, which is obviously in part driven by our net overseas migration figures. It's expected to remain very soft unless the Australian government can really do something to stimulate reproduction and a natural increase in our birth rate. Now, as I said, do stop me if you have any questions. Mindful of the fact there's a lot of information we're going through, and hopefully it's helpful, but otherwise we will get straight into some of the announcements for both Australian residents and also expats. So first and foremost is the Australian resident updates. Now, some of these will apply to expats, some of them won't, but they'll more apply to those of you if you're looking to return to Australia in the short to medium term. Now, we've had 4 key announcements that we think are relevant to our clients. One is the LMITO, the low and middle income tax offset, has simply been extended for a further 12 months. This is just the Australian government's way of giving you $1,000 to go out and spend, essentially, and stimulate some economic growth. So if you're earning between $48,000 and $90,000, you'll receive the $1,080 as an offset. If you're earning less than $37,000, you'll receive $255. So as with a lot of things in this budget, if you're earning too much money in Australia, you really receive nothing. You're effectively viewed to be earning enough and are already doing your part, I guess, to stimulate economic growth. The other interesting announcement was, and we saw this one announced a couple of years ago now, was the First Home Super Saver Scheme, which allowed first-home buyers to contribute money into their super fund up to $30,000 as voluntary concessional contributions, and they could then withdraw that money to then go and buy their first home. Now, it's a little bit like Singapore's CPF system in the way they structure their ordinary account and the way that both permanent residents and citizens can utilize the system to buy their first home. But what's been announced in this budget in Australia is that they can actually contribute up to $50,000 now and take out that full amount to buy their first home. Now, while I think it's lovely that Australian citizens, Australian residents rather, should have the opportunity to buy their own home, particularly first-time buyers. Do I feel it's the right thing to have that market prop up the Australian housing market? I'm not quite sure. So my advice here would be tread with caution. If you are either a first-home buyer or if you have young first-home buyers in your life, please ask them to tread with caution. This is an awful lot of money they could be taking out of their retirement savings and may actually come to bite them in the backside later on. So I'm not too sure how positively I feel about this announcement, but it's out there. The other one was obviously a bit of support to single parents. So the Australian government has announced 10,000 guarantees for single parents when it comes to buying their own home. It doesn't matter if it's their first home or second, third, or otherwise. They will provide 10,000 guarantees from 1 July of this year to allow single parents to buy a property with as little as a 2% deposit. So if you're buying, for example, a $500,000 home, that would mean all you need is a $10,000 deposit. So obviously quite a boost to single parents. The last one was a very small increase to education deductions. Currently, the rules state that if you are looking to study something relative to your income or your field of employment, you can currently claim anything above the first $250 that you spend. Now you'll be able to claim the full $250 as well. Again, for most of us, that's not going to make a meaningful difference, but a small boost for those that might be looking to get a leg up and sort of climb up that corporate ladder. A couple of other things that have been announced. We saw some positive announcements around superannuation. 3 key things that have been announced here. One is the downsizer contribution age has been reduced. Now, what this means is that if you're living in Australia in your own home, you can actually sell that home to buy something cheaper and contribute the difference up to $300,000 into your super fund. So there aren't any work tests or anything that applies. Currently, you just need to be 65 years or older, and the contribution limit is capped at $300,000. Now that's going to come down to 60, which is really just going to give those of us that want to retire in Australia a bit more flexibility around how we plan for that. We might be living in a house, the kids might move out, and we might want to contribute that money into our super fund. So a positive, but fairly minor announcement. The other one that's been interesting and will no doubt receive some sort of controversial feedback, I would imagine, is currently the rules in Australia stipulate that if you earn less than $450 a month, you will not receive super guarantee contributions from your employer. Now that is set to be scrapped, proposed to be scrapped. So if you earn less than $450, you will indeed receive super contributions. Now, this is not terribly tax effective for those that are earning less than $450 because they will be taxed on the way into super. However, given the fact that most people earning less than, say, $1,000 to $2,000 a month are not saving anything for their retirement anyway, I actually see this as a positive step. If we can get to the point where financial literacy and education is just so strong that everyone's saving for retirement without being told to do so, I would be very happy to see this one repealed, but otherwise I don't actually mind it. While it may not be the most tax effective, I feel it's a positive step nonetheless. The other one, which may not impact too many of you at this stage, but again, something to keep in the back pocket, is that the work test is going to be repealed. So if you're 65 to 74 years of age, living, working in Australia, to contribute to your super fund, you have to satisfy the work test, so minimum number of hours each month in employment. That is set to be scrapped. So you'll be able to contribute both voluntary and involuntary or non-concessional contributions into your super fund once those rules are scrapped. So that's sort of it on the individual side. Again, there were a few announcements around childcare and a few other things that we've already touched on, but nothing else terribly meaningful. The next one was around Australian businesses. Again, it was a bit of a cash splash, trying to, again, create some short-term spending, potentially to get the votes. next year, or whenever the election happens to be called. So 3 key announcements around Aussie businesses. The first was around asset expensing. So if you buy an asset that is used for your business in Australia, you can fully expense that asset over a 12-month period, and that has been extended for a further 12 months until the end of June 2023. So if you are working in Australia, or you are thinking of buying a business in Australia, it creates a bit of a short-term incentive. Excuse me. The next one was the loss carryback. So what was announced in the last budget is that if you're an Australian company working in Australia and you earn less than $5 billion, quite a large benchmark or threshold there, you can actually carry forward your losses from previous tax years. So what that means is that if you've lost money in previous years, you can actually carry those forward and utilize those losses to offset future gains. All that's happened there is we've seen that extended for a further 12 months. Again, a nice short-term boost. It does feel like a bit of a vote grab. What would have been nice is that if that was actually extended indefinitely, but sadly that was not the case. The last sort of key announcement when it comes to Aussie businesses was the tax cut to SMEs. This is nothing new. It was just reiterated in this year's budget, and that is that the corporate tax rates for SMEs will drop from 27.5, 26 to 25 from 1 July of this year. Again, not a huge deduction, but if you are earning a reasonable amount of money via a business in Australia and you do meet the SME criteria, some positive news in terms of net income. What's missing? Gosh, where do we start? A number of things really. As I said, it would have been nice to see an indefinite extension on those losses being carried forward for Aussie businesses. The job seeker clarity, while it would be lovely to think that everybody in Australia should have a job, I'm also very mindful that it would be extremely stressful knowing that your additional income, if you are on job seeker, can be taken away as soon as that support payment is actually withdrawn. One of the biggest factors missing for myself was really any sort of funding being dedicated to improving quarantine facilities. Clearly that is not going to win any votes in Australia. So there was just absolutely nothing there. There was no real meaningful support thrown at businesses that are aligned on tourism, whether it be hospitality or universities or private education or healthcare. It would have been lovely to see a lot more support thrown behind those businesses. Paid parental leave, as I mentioned, received nothing. So still, and it is typically largely women who are taking paid parental leave for a longer period of time, which is putting a huge detrimental impact or dent in their final superannuation balance. So this is really one that should be addressed. We should see some equality here going forward. And the other one, as I mentioned, was really the education sector. So let's move on to the key announcements that impact us as expats. This is relatively short, but there have actually surprisingly been a few positives when it comes to us as expats. So the first one, or the 2 key announcements, were really around tax residency. So the first is for us as individuals. Currently, for anyone who's tried to investigate whether they're a tax resident of Australia for tax purposes or not, will have found that it is extremely difficult, particularly if you have businesses or properties or various ties to Australia, to actually get a clear answer. It's not as simple as 6 months of the year in Singapore or elsewhere. There are a number of tests. What has been proposed or what has been announced in this year's budget is that that will become a lot simpler. So what has been proposed is that they will move to a physical presence test as the primary test. So, and that will be based on 183 days in the country, i.e. if you don't meet that criteria, you may not be deemed to be an Australian tax resident. Now that is great news. If that test doesn't apply, there will be some secondary tests which are yet to be clarified. and they will be based on measurable, which is an important word there, and objective criteria. So not the convoluted tests that we all have to go through at the moment, but far more quantifiable criteria. So for those of us that are traveling to and from Australia, a little bit concerned about our tax residency, particularly for those of us that might have family living back in Australia, our husband and wife, children, this is going to be a very positively received announcement as part of this budget. Just jumping to the bottom here, staying on the topic of tax residency, has been a significant improvement in the corporate tax residency rules as well. So currently, to be deemed an Australian tax resident as a business, the central shareholders or management and control need to be in Australia, and there needs to be effectively some business carried out in Australia. So again, it's quite grey, it's quite convoluted. A lot of businesses could be caught up in this when they perhaps shouldn't be. So what we're going to see change here is that the corporate tax residency rules are going to change to the business must have significant economic ties to Australia, which loosely translates to the majority of your business must be conducted in Australia, the majority of your clients in Australia, and central management or control must be within Australia with Australian shareholders. So again, a lot more clarity here. It's a huge step in the right direction. We'd certainly love to see a bit more. We'll be providing more updates on both of these items because we're very aware that this will impact a large number of our clients, but certainly a positive. The last key update here, which I've outlined, is just the fact that there have been no changes to concessional super contributions for expats. So we can still carry forward our unused concessional contribution limits, i.e. $25,000 a year. That is set to increase to $27,500 from 1 July of this year. So if you're not currently contributing to Australia, you're looking to move back, it may be quite a nice tool to keep in the back pocket to actually boost your super contributions, particularly if you're looking to live and work in Australia again. So hopefully that'll make sense. As I said, if anyone has any questions, please do stop me and ask in terms of the expat updates. Otherwise, we will plow ahead. Now, just one key update I did just want to highlight here because we are facing this question more and more. It's not particularly relevant to the budget, but I do just like to include it to be very clear here, is tax residency for Australian expats. Over the last, 15 months, ever since COVID hit in the Western world in March of 2020, we've seen a lot of people working from home, as most of us are back to doing here in Singapore. And what that has also meant is that a lot of people have thought, well, if I can work from home, why don't I just go back to Australia and I'll work from there? Because I've got more freedom in Australia. It's a big wide land. I can take holidays and explore and maybe even spend some time with the family. Now, the downside there is you may be deemed to be an Australian tax resident if you voluntarily left Singapore to voluntarily go and work in Australia. Again, please do seek advice here if you are in that grey area. The current rules are basically that if you can return to your normal residence, whether that be Singapore or somewhere else, then you should. Otherwise, the ATO may deem that you're voluntarily staying and working in Australia. So just be very mindful of this and make sure you do your homework here. So what's missing when it comes to us as expats? Look, a few key things. We've already touched on a few of these. There has been no update, and nor are we really expecting anything on the main residence exemption. We don't get the 6-year rule as Australian expats. If we sell a property in Australia while we're offshore, even if we've lived in it previously, there is no exemption. We will pay tax from purchase price. Now, it doesn't mean a hard and fast, don't sell property while you're offshore. It just means, again, seek advice, be prepared for what the outcome is going to be. The international travel update, I mean, goodness me, the Australian government has really bungled the vaccine rollout to such an extent that this just keeps getting pushed back. further and further, as has been highlighted by every time we read a Qantas update. It was March, and then it was June, and now it's 2022, and now it's maybe late 2022. Again, we're not terribly surprised here. It was always going to be a bit of a wait and see approach. But obviously it would have been nice to see something a little bit more clearer, particularly when it came to the quarantine funding, whether that be some sort of work camp, FIFO camp sort of setup. Again, we've obviously seen nothing there. The other one is incentives to return. Well, gosh, we've seen a small downtick in the corporate tax rate, but otherwise there have been really no other incentives for Australian expats or Australian citizens or permanent residents who are living offshore to actually return to Australia and invest money in a meaningful way. So that's really sort of the crux of the budget. I hope that's helpful. I do just want to share with you a couple of updates in terms of where we're investing, where we sort of see money flowing, some related to the budget, some not. And then, yeah, we'll stop. And if you have any other questions, obviously more than happy to take them. Otherwise, I will leave you to it. So in terms of where we're investing, where we're placing money at the moment, and also where we're not. So a few key sectors, the Aussie banks, a lot of superannuation funds, a lot of generic Australian investment portfolios are always going to include some bank exposure. We think they've had a very good run. Up till now, obviously residential property has been booming. We've seen interest in refinancing, new loan applications stronger than ever. However, now that the Australian banks are largely out of wealth management and out of insurance, and their interest margins are at rock bottom, we're not really seeing any meaningful growth in the Australian banks going forward. That's not to say I would be going out and short selling them. I think that's probably a little bit aggressive. You might even argue unpatriotic, but certainly not something we would be actively buying at this point in time. The other sectors, sustainability, ESG, anything with ESG in the title, renewable energy, waste management, cleaner packaging. ESG is environmental sustainability and governance. So anything that meets those criteria across different sectors is going to, or is already receiving, a significant boost. We saw the largest growth in the 2020-2021 year that we've ever seen in terms of new investment into these spaces. The idea of the triple bottom line in terms of not just about finances, but also about ESG, we think is going to become a thing of the past. And if you don't meet the ESG requirements, you're simply not going to receive any investor interest. And we're seeing a lot more demand amongst superannuation funds, pension funds, and the same in Singapore with CPF also. The other sector we love, cybersecurity, regulation technology, compliance technology, anything scalable, particularly as we head into an era where Alibaba, Tencent, various other tech giants start to expand through emerging Asian markets, Cambodia, Myanmar, Indonesia, Vietnam, for example. We are going to see a huge need for enhanced scrutiny, greater compliance checks, and it's going to need to be scalable, and it's going to need to be digital. The sophistication of cyber hacks these days, particularly with COVID, has received a very unwelcome boost, but it does just highlight the need for a lot more money to go into this sector, which is certainly why it's one of our favorites. Digital e-commerce, payments, look, obviously a growth sector for a number of years. We do see a lot of opportunity, particularly in the Chinese giants here. They've been facing some regulatory challenges over recent months or over the last 12 months. And we think it's actually creating some good buying opportunities there, particularly those with the right time frame when it comes to investing. And lastly, one of the other sectors we love is esports and gaming. Again, gaming, obviously, we're really just transitioning from the sort of standard Netflix to whoever is going to be the Netflix of gaming. Yes, a lot of people still go out and buy a console, but now everything is online. It's all with a headset, it's all with talking with other gamers all over the world. But what we're a lot more excited about is esports. the number of new players who are not traditionally playing sports, particularly in markets like India, are now all over esports. And I think as soon as we start to see companies truly monetize these business models, we're going to see some really interesting opportunities here. So that really is it from me. I really do genuinely hope that that's been helpful. If you have any questions at all, please do feel free to fire them through. I will send you an update and a recording of the webinar this evening also. So you'll have it there. If you have any questions, obviously post this evening. Please do feel free to reach out to me at any time. Likewise, if there's anything we haven't covered tonight, then yeah, as I said, please do reach out. More than happy to spend a bit of time with you offline. So yes, please do fire through with any questions. Okay, so first question we've got here is really just around markets. So effectively the question is, do we see a pullback, particularly in the sort of tech or high growth sector? Look, the short-term answer is yes. However, how much that's going to be, how long that's going to last, obviously is very uncertain. We would see it more as a buying opportunity, not in everything. So we don't particularly want to go out and invest or buy those companies that are trading at valuations that just don't make any sense in this real world. But other companies in sectors like solar energy, wind, other renewable energy infrastructure, for example, we would certainly see this as a buying opportunity as prices start to come back. Okay, so next question here has just been around inflation. So there's been a bit of chatter about inflation coming back, what that might mean for markets, for investors. So the question is really, what is our view on when we might see inflation? Should we be worried about inflation in the short term? From our perspective, we don't see any meaningful inflation for the next 2 to 3 years. We would expect to start positioning for that in 2023, 24. The reason being, we're not expecting any meaningful wage growth, and we're not really expecting to see anything in terms of meaningful upward pressure in the price of goods and services either. So while there's been a bit of chatter, we saw government bond yields spike in March relative to where they were. We're not really seeing that that's going to be a meaningful or sustained uplift in terms of inflation. But certainly something we'll be watching, particularly from a wage level rather than the demand side. Okay, well, look, that seems to be all our questions for now. So hopefully, as I said, hopefully that's been really helpful. Again, really appreciate you giving up your Thursday evening or wherever you may be, Friday morning or Thursday morning. But otherwise, really appreciate your time. I'll reach out to you tomorrow with a copy of the recording. And as I said, please do feel free to reach out to me with any questions that you have. And otherwise, have a great evening or enjoy the rest of your day.